Hello, thank you so much for tuning into Morning Markets. What do all-time highs really mean? Certainly, they mark an official end to a bear market. What does it mean in terms of future returns? Because really, even though we're at fresh all-time highs, we have really just traded sideways for 2 years. Let's bring in Lukasz Tomicki. He is the founder and managing partner of LRT Capital Management. Lukasz, thanks so much for being with us. What do all-time highs mean to you as an investor?
Well, good morning, and thanks for having me. I think all-time highs simply mean that future returns and expectation returns are lower than they were before. There's a lot of really good news priced into the markets today, and the market is pricing in about 130 basis points of Fed rate cuts this year. At the same time, it's pricing in very aggressive earnings growth of about 13%, which is double the historic average. And this means that the market's kind of priced for perfection. And as Warren Buffett likes to say, a plan that assumes perfection is a plan for disaster.
So it sounds like you don't like to add more capital at all-time highs and that you think there is a risk of a pullback.
Yes, I mean, if you look at the S&P 500 earnings for the last 12 months are about $185 in total. If you slap on the 13% that analysts are expecting that earnings will grow this year, that gets you to about $210 by the end of the year. And think about where interest rates are. If the 10-year is at 4%, kind of where it is today, you add 4% for an equity risk premium, a historic value for the equity risk premium. Well, that gets you to a justified PE of 12.5 and about 40% downside in the S&P. So let's say I'm being too pessimistic. Let's say the 10-year declines to 3% or even 2%. And investors get very optimistic and only demand 300 basis points of an equity risk premium. Well, then the downside is another 12%. So it's very, very hard to come up with a rational scenario that suggests that the market is fairly valued or can deliver you good returns this year. The only way I see positive returns this year is if we return to the kind of bubble that we had in 2021 or the late 1990s. And that could happen. It is possible. But I don't think that should be the base assumption of any investor.
Yes, I just want to underline your point. You're saying that at a base case, you could see a 40% decline?
That's right. If you just simply look at the numbers where they stand, that's where the market should be trading.
And yet, during the worst of the pandemic, we didn't even fall 40%. And that was, such a case study of the S&P's unrelenting ability to climb a wall of worry. I mean, it has gone through a pandemic. It's gone through a financial crisis. It's gone through, the two most recent presidencies. And it's gone through unprecedented historic rate hikes. I mean, this is just a sector that is built on, an index that seems to be built on resiliency.
It is very resilient. But you have to remember, during the pandemic, the reason the market didn't fall 40+% is of massive intervention by the financial authorities, and not just in the United States, but around the world. So certainly, if you believe the Federal Reserve is going to cut interest rates to zero and do massive quantitative easing and start buying assets left, right, and center, then they can always make the S&P go up. But in the current environment, to assume that interest rates will be cut back to zero and we're going to restart QE, that seems a little aggressive at the same time that people are predicting earnings growth at roughly double the historic average.
Is it worthwhile for long-term investors to be so concerned with the downside versus just holding through it or using it as an opportunity to buy stocks? And I ask that because I'm looking at the chart of the S&P going all the way back to 2000 and 2008, the most scary times. Since then, we're up 200%. If you sold then, you would have missed out, a decade or two later on some of these really massive gains. And I wonder if, obsessing over that 20%, 40% lower really serves a long-term investor.
No, I don't think trying to time the market or day trade or obsess about quarterly results serves a long-term investor. But I do think you should be rather buying on weakness than buying on strength. And the reality is that the valuations in big tech, and especially the smaller tech names, the unprofitable tech, are very, very high today. So to the extent you're putting new capital to work, it makes sense to put capital to work in areas which have not performed so well over the last 12 months. And if we do get some meaningful downside in the market, which we could, then it's a perfectly sensible time to put money back to work in the main indexes.
Okay, let's talk about a stock that exemplifies both of those strategies. So one that you've been buying on weakness.
Sure. So we like the energy sector where it is today. It's down effectively for the last 12 months. Energy has been flat, and the stocks are quite cheap. So we own a little bit of ExxonMobil, household name that I think everyone knows, but it's a business that's sensibly valued. It's very resilient. And if oil prices were to go up significantly from here, which they always can, then you're going to get probably an excellent return over the next 12 months. And if oil prices do nothing, then you're still probably looking at low double-digit returns. So it's about the risk reward for me. So ExxonMobil, Chevron, the big integrated players in the U.S.
And what's the stock that you're waiting for to go on sale?
Well, I think NVIDIA one day may be on sale, but it's certainly an excellent company. But it's a business where the valuation and investor sentiment drives so much that it's very hard to see today, much risk versus return, if you will. So certainly the big tech names like an NVIDIA, like some of the semiconductor names make sense. We do own some Taiwan semi in our strategies. We've been trimming some of that recently on the big pop it's had, just based on the expectations that it was going to report better results. But we continue to own some of that. But should there be a meaningful decline in semiconductors, big tech, 20, 30% type declines, which can happen at any time. We saw that last year. Stocks were down substantially, from August, July, September. That would be another opportunity to buy.